Hello, this is Doug Gerlach from iClubcentral. Welcome to our Investment Club webinar. Today is Tuesday, April 18th, 2017. It is tax day, but of course all investment clubs filed their tax returns long ago, so tax season is now just a memory all behind us, and I hope your tax season was smooth sailing. Tonight, joining me is Russell Malley, who is iClubcentral's Club Accounting Advisor. So Russell will be chiming in, and as you can see, our topic tonight is investment club performance and returns. We're going to talk about how to evaluate your club's performance as well as the performance of the securities that you own. We're going to take a look at measurements and compound return, simple return, total return, provide some definitions and hopefully some clarity that can help your club figure out exactly how it's doing. Before we get started, let's review our housekeeping for our presentation tonight. If you're having technical problems at any point, please contact GoToWebinar directly via their toll-free number or via their website where they provide 24/7 customer support. If you can't hear me now, if the sound or graphics are choppy, we recommend that you turn off any unnecessary programs that might be running on your computer, particularly those that may be running in the background, that you not connect using Wi-Fi if a wired connection is available, and a reminder that you can always listen using the telephone if you need to, and that will free up your computer to deliver the video component of our webinar. If you have questions, please use the GoToWebinar application to type in your question. You don't need a microphone in order to participate. We are monitoring those questions. We'll do our best to answer them during the presentation as well as at the end. The handout for tonight's presentation is available in the Handouts tab of that GoToWebinar application. So you can go ahead and click that. It is a PDF format, so you can save it to your computer. You can print it very quickly or access it later, take notes, and we will also provide that PDF handout when we archive this webinar presentation. Our complete archives and schedule of upcoming webinars can be found on iClub.com in the Learning tab. So go there to find out what's coming up for all of our iClubcentral webinars, our Toolkit Fixed User Group, our Lunchtime Stock Club, as well as our Investment Club operations and other special webinars that may be scheduled. The handouts are typically provided in the GoToWebinar or the webinar archive that you'll find the link there on the right side of the page for details of the webinar, and the PDF is available there. So you can always grab it even if you're not viewing the entire presentation. You can find out more about iClubcentral and keep up to date with all of our news and activities on Facebook, so we urge you to like us there. And you can also find us on YouTube. We have a new YouTube channel. We're growing with the addition of webinar archives and other videos. Search for iClubcentral and subscribe there as well to get updates when we release our archived webinars to the YouTube channel. We also have a YouTube channel for our Investor Advisory Service newsletter that's been growing quite well, so you might want to check that out. We have our subscribers-only webinars that we've released to the public, so you can view those and learn more about our award-winning stock newsletter from the YouTube Investor Advisory Service channel. So tonight we're talking about evaluating club performance. Many clubs go for years and years, and they're not quite sure exactly how they're doing, and members may be satisfied with the education and the experience they're receiving in learning how to invest in the stock market. But it comes a point where your club might want to know, how are we doing relative to the market? Are we better off putting money into an index fund or having a broker manage our money? Are we better off managing it on our own? Or is the club really providing us with a decent rate of return that justifies our continued operation? Well, as part of the educational process, we provide in clubs with the tools to evaluate their performance. But there are always a lot of questions, so tonight we're going to address those questions and help you to understand rates of return and what's comparable and how to truly measure your club's performance using our myiclub.com website. So typically clubs want to know, how are their stocks performing? That's a very key indicator that lets you know if your club is making good investment decisions and good portfolio decisions. You might want to know how your club portfolio is performing as a whole. Are all of these stocks going up and justifying your existence as an investment club? Are you really building a portfolio that is tuned to the long-term needs of its members? And also, you might be interested in how your particular performance in your club is doing. After all, you are investing in your investment club. So by putting money in on a monthly basis, occasionally you may wish to add more money. You can evaluate how well your club performance, your investment in your investment club is generating a return for you. And it may come a time when you decide that your club is just not performing to your expectations, and maybe it might be time for you to break with your investment club. But there's only one way that you can find out, and that's by looking at the data and looking at the performance reports that we provide as part of the My iClub tool set. Now, before we get started, we need to understand the concept of a simple rate of return. This is the actual change of an investment's value, and it's perceived as or displayed as a percentage. Sometimes this is known as the cumulative return. So if you bought a stock that was $100, and the current price today is $200, you have a 100% return in that investment. And sometimes we see stock promoters and newsletter advisors touting the outlandishly high rates of return, of simple return, of their recommendations. But what's missing in that 100% rate of return is the time period. Did you buy the stock last month, last year, or a decade ago? And so that 100% rate of return might change over time to be something quite fabulous, to be something quite subpar. So what we need to know is the time value of, or the amount of time that's used, that's included, and figure out a way to convey that when we're looking at investment returns. As an example, here is a club that bought a stock, ResMed. They invested just over $2,000 in it when they bought their first share of stock. About 2.5 years later, they bought an additional $1,500 worth of the stock. So their cost basis, as indicated by the blue line, is $3,558.79. That's their cost basis. Their current value is $3,815.90, as indicated by the orange line there. So that means they've come out ahead. Not always. You can see here at this point the market value fell below their cost basis. So at this point they were actually holding that share, those shares of stock at a loss, but the price came back, and so now they're holding it as a gain, and their simple rate of return is 7.21% over just over 4 years. So is that 7% return, is that a good rate of return? A lot of that depends on what the market is doing. A lot of that depends on the club's objectives in terms of the investments that they've made. So we can't really say is 7.2% simple return good or bad. But we do know that it is a plus value. And so for many people, that's all they need to know. They've made a little bit of money in the stock. But the better approach is to look at what we call the total return, which is the actual rate of return of the investment over time, including the appreciation of price. And usually that includes dividends as well, because if stocks pay dividends, that's part of your return. And so you want to add those in to calculate your total return percentage. Now, we usually display total returns, however, on an average annual compounded rate. So in other words, if you're familiar with the stock selection guide, the objective of purchasing a stock, when you're using the better investing methodology, we shoot for, or we're taught to shoot for, a 100% total return over 5 years. So the simple rate of return is 20%, but because of the effect of compounding, we know that the average annual compounded rate of return that's required to generate 100% simple return is 14.8% roughly, rounded up to 15%. So a 15% compound annual rate of return will get you to the same place as a 20% simple rate of return over 5 years. Now in Toolkit, we use something called total return, but we're looking, as well as the stock selection guide, but we're looking forward with that total return value. So this is a projected total return, that if our stock meets the objectives that we set out for it, the judgment that we applied, the growth rate and the PE ratios, and reaches this price that we believe is possible in 5 years, what would be the annualized rate of total return to get from the current price to that projected high price 5 years down the road? And so we call that the projected total return. Now, in the terms of evaluating performance, however, we're going to look back at your stock holdings over the course of the period that you've owned them, and we're going to do the calculations required to generate that total return figure. Now, the other figure that you need to get familiar with is what we call compound annual return, or CAR. Now, this is very complicated to calculate. It's similar in many ways to the compounded interest rate that's paid on a mortgage or earned in a savings account. Maybe when you were a kid, you learned about compounded rates of return, and you learned how compound interest works. And so we're using similar concepts there. We're using what's known as the internal rate of return, IRR, to take into account the point in time in which an investment was bought and or sold, and the amount of money that was invested in or removed in the transactions along the way. Now, this gets really tricky when you have a security that you've bought multiple times. So maybe you've bought several lots, maybe you've sold some lots, some shares, maybe you've received some dividends. So when we take all of those transactions together, we see money going in and we see money coming out. We see the number of shares increasing, we see the number of shares decreasing, and so it becomes very complicated, as in our ResMed illustration earlier. We had two purchases. So if we really wanted to figure it out, we could figure out the rate of return on each of those purchases and get a simple rate of return, but it's still not telling us very much. What we want to know is how that internal rate of return is calculated based on all of the cash flows coming in and out of each security in the portfolio, and then we repeat that to figure out the rate of return for the entire portfolio. So this is a very high-level view of compound annual return, but it's important to understand the concept. And the key things are the time element. So we're taking into account how long you own a particular security, how long you take money out, sell it, buy it, receive dividends, etc. If it's a non-stock, you have distributions, perhaps returns of capital. So all of those affect the rate of return that's calculated. And as the first bullet point says, this is very complex to calculate. You can do a lot of these calculations with a financial calculator. You can do even more with a spreadsheet, but it's not something that you can really do with paper and pencil or a simple calculator. So things get very complicated very quickly. And what's that perfect for? Of course, that's perfect for software and a computer. So we can calculate these values. And in fact, there are industry rules that govern how rates of return should be calculated, and how those calculations are used in advertising, for instance. So mutual funds are required to use approved methods of calculating returns so that we know that as consumers of these financial products, that we can compare apples to apples, that one company is not using a different sort of calculations than someone else to display the performance of their security. So the compound annual rate of return for our ResMed, and again, based on that same illustration, so the total cost, the total investment into the security was $3,568.78. The market value as of the time of the report was $3,815.50, and the compound annual rate of return for all of the shares owned was 4.17%. So on an annualized basis, the shares were growing in value just over 4% a year. And the simple rate of return, remember, was 7.2%. So in this case, we kind of get a sense that not because of the multiple lots, you can't just say 4 years times 4% of annualized return gets us 16%, because each of the two lots, the original lot and then the lot that was bought 2 years later, have their own cost basis. And so we're going to do the calculations. They're all going to change relative to every security that and every share of every security in the portfolio. Now, so that problem comes with that compound annual rate of return because it's an annualized rate. So the question is, well, what happens if you own a security for 6 months or 2 months or 2 days or a year or even 18 months? How do we calculate that annualized rate of return? And so what the formula tells us is that we're going to extrapolate based on the period of time that we have and figure out what would be that rate of return if it continued at that rate over the course of a full year or multiple years of time. So as you might imagine, we get some irrelevant results using compound annualized rates of return for any short period, especially where there's a big price movement. In the example here, you can see a valuation statement for Apple when it was bought. In this example, this is a fake company, Apple, that was bought when it was $386 a share. In 3 months, it was $509 a share. So it really took a jump upward, and the compound annual rate of return in this example was 301.46%. Well, obviously, that there's no security that's going to continue to grow at 300% a year for multiple years. But we do expect that stocks jump up and down in price in the short term, and we can see these massive swings in compound annual return. Now, does this mean that this value is incorrect? No, it's absolutely correct. If this stock, if this security continued to grow every 3 months, going up, almost $150 then yes, it would grow. It would triple every year. But in reality, that's not likely to happen. Mathematically, it's absolutely correct. And given what we know about the stock market, it's incredibly unlikely to happen for even a year, no less multiple years of time. So we need to apply some judgment and some perspective on the compound annual rates of return when we have situations where, where the short periods are involved. Now, in our myiClub.com website, on the valuation statement and the member status report, you can choose to include compound annual rates of return. So there's an option for the treasurer or for anyone actually to choose the compound annual rate of return. You can choose a report date and then start return calculations from any date, and then down here is the option to include the compound annual return in the report. So it's the same on both the reports where we can make that adjustment. Now, we recommend that for the first few years, at least the first 1 or 2 years, that clubs ignore compound annual rates of return. They're going to be likely to be largely negative, and that's because of the club's operating expense, startup expenses. That's going to eat into returns, the cost of starting the club up, and the other is that the club will likely to be less experienced in making investment decisions, and so that's going to have a negative impact. And finally, stocks tend not to go up. If you're using the better investing approach, we tend not to see immediate price growth after we make purchases, because we're looking at stocks that are reasonably valued. Often they're below the high prices that they've reached at some point in the recent past, and so they tend to take a little bit of time before fundamentals drive that price growth higher. And so there are a lot of reasons that that tend to impact the performance of clubs once they're just getting started. So we recommend to not even look at compound annual return for your first couple of years. Ignore it. It's just not. It's not going to provide you with actionable information. You want to give your stocks time to work themselves out and to deliver the returns that you're looking for. I'll flip over to our myiClub.com website, and you can see here in the new site we have the ability now to go to the reports, go to the valuation statement, and you can include the compound annual return in the valuation statement. There's a little link here that says, "What's this?" You can click that. It pops up a little little text that gives you a little bit of information on what compound annual rates of return are. But if you want to display the compound annual rate of return, click Submit. And then for every security you'll see here, we have the compound annual rate of return. And the figure that's shown there, the date rather, this is the start of the club. That's the default. So you can see here it says compound annual return since 9/13/97. So that means that this is the these percentages are calculated since the club began, or since the first shares were purchased. So actually, not since the club began, but since the oldest shares held in the security. In the portfolio. That would be a more accurate description going back in time to when the club started. So if you look at this, 9/13/97, if you look at all of the club purchases over here, you'll see there's a purchase of RPM on 9/13/97. So that's the oldest held security in this portfolio. There may have been other securities that were bought before that time and sold afterwards. But this is when we can start the calculation for compound annual return. So this is since the first purchase of each of these stocks. So this 10% return for Walgreens down below is 10% a year since February 4th, 2008. That's the compound annual rate of return for that security. So it's typical. You're going to see some securities held at something of a loss, some securities that are showing nice gains, and that is pretty standard. Now, what it doesn't tell you when you're looking at this is you might see a security that's showing you, in this case, minus 51.07%. And this is just a tiny security that has a very small market value. You see, it's just $6.40 in the portfolio right now, 4 cents a share. It's largely a write-off that hasn't been written off yet. But again, just as an example, in 10 years, the stock has gone down 50% a year, so it's gone to practically nothing from the club's initial investment in this particular security. But the percentages don't tell us much relative to the entire performance. So you might see other cases where, for instance, the Fastenal up above, we see, in this case, a 1% annualized rate of return. And again, the club invested in 2008 $778. It's worth $728 today, minus 1%. But because this is a very small amount relative to the club's holdings, it's not going to have a big impact, right? So there's again, there's more for us to worry about than simply the amount of the percentages. Now we can do the same thing with the member status report. If we click on the member status report over here, we can include the compound annual rate of return. And this will show us our rates of return for the individual members. And so this is where you might say, okay, if we look at Madeline Albright here at the top, she has a compound annual rate of return since she joined the club of 13.3% a year. So you can see some members have rates of return as low as 3.2%, 0.1% a year, 10%, 9%, and you can almost see a lot of these members at that 13% range probably are founding members of the club. Then we have some newer members who might have come in and haven't seen the good years, for instance. So again, but that's how you can kind of compare your performance in the club relative to if you had simply been indexing in the market, and if the market had gone up an average of 12% a year and you were getting 13.5%, you might say, yeah, that's pretty good. I'm outperforming most professional mutual fund managers with my investment club account. So Russell, you had something to say about our valuation statements, right?
Right. Sometimes when you hold a stock, it does really well or very poorly in the early years, and that can mask what it's doing recently. So if you want to know what it's doing recently, you can use that start return calculations from and choose a date. My club was really interested in what's the stock done recently, and is this past performance masking what it's doing recently. So we decided to include an 18-month return. So we choose a valuation date about 18 months before the current date. So we know what a stock's been doing fairly recently. That's not a hard and fast rule. You could use 2 years, 30 months, whatever seems right for a club. But sometimes, if a stock takes off really well in the beginning and then it's a few years later and it's had several years of flat, it's going to see the total compound annual return over the full time is going to look decent, but you may see that maybe in the past 2 years it really hasn't done anything. So you might want to think, okay, that's a stock we want to go and study, see why it's gone flat for a couple of years. The opposite may be true. It went down early and now it's starting to take off, but its returns look really poor for the whole holding period, but it's been doing well recently. You might want to see why is that. Maybe it's a signal to add some more to it. Maybe not, but it's a signal that you might want to go and take a look, maybe reanalyze, do another SSG on the stock.
In this case, let me give you an example here. So I've changed the start return calculations up here to December 31st, 2015. So we've got 16 months of 15, 16 months, and the total return, if you look down below, is 10.16%. So that's going back to as long ago as 1997. So from here, if I go ahead and click the submit button, we can see down below that the club portfolio return is actually 12.9% on an annualized basis. So that's kind of, again, giving you a little bit of comparison there that says recently our picks have been performing a little bit better than they have been over the longer history of our club. And again, we don't know at this point. We can say, well, that's the market. It's a bull market. Since 1997, we've had a couple of bear markets and corrections that have impacted things negatively, perhaps. And we got rid of a whole bunch of winners that we sold out of the portfolio that aren't being reflected here. So there are all sorts of kind of things, the factors that might come to play But it is, again, a useful intellectual exercise to kind of talk about it and think about it and look at things in a little more granular way. And I agree with Russell that looking at the returns can be a way of identifying companies that that might have some fundamental issues that we want to take a look at. It could be that, but it could also be that maybe some of these stocks that have declined in price are representing good opportunities at the current price. But we always want to be aware of why we believe a stock is changing prices. It doesn't mean that we're going to take action right away, but we do perhaps want to take a look at some of these companies as part of our portfolio review. The price change can kind of trigger that portfolio review that we miss when we're looking at the changes in fundamentals and quarterly factors that come into play. So let me flip back over and let's carry on with our discussion. Oh, Jerry says, can we display compound annual return on the member status report in Club Accounting 3? And the answer is yes, you can. This compound annual return column is available in Club Accounting 3 in the member status report and the valuation statement. So we started to touch on individual member performance when we looked at the member status report, and so we just follow up. When we look at member performance, what are we actually considering? Well, we're considering all the money that a member has put into the club, all the fees they paid, all of the income that they've been allocated at tax time, all of their withdrawals. So for most clubs, that means that at least 12 times a year they're putting money in. So we can't simply take the amount of their club capital account at the beginning of the year, figure out their club capital account at the end of the year, and then calculate the percentage change and says that's your rate of return. That doesn't work because we're continuing to add money. So a lot of that increase in value potentially is coming from the member's own capital being deposited into the club. So as a result of this, you can look at members that have similar total amounts, but they might have different cash values, different units owned, different compound annual rates of return, and that's due, in fact, in part to the timing of when they put that money in. A member, a long-standing member who invested a regular amount year after year after year after year after year might have the same amount invested as a new member who came in and really put a lot of capital into the club, more than the minimum, and in a few years had the same total amount invested in the club or own the same percentage of the club as that long-standing member, but the rates of return are going to be wildly different potentially. And that's, again, that's not a mistake. It comes down to when you put the money in and how much you put in. And the software, again, it does an excellent job of calculating that. Here we have a sample member status report where you can see big changes in the compound annual return. You can see some members have 20% rates of return. One member has a 20% rate of return, we'll say. Other members have a negative 5.5% rate of return. A couple of members are roughly even, and then we have some other members in that 9.8%, 4.9%. And again, it doesn't necessarily have to do with who owns the biggest part of the club. The member here with the largest percentage ownership has one of the lowest rates of return. And again, here's another member who has a bigger percentage ownership and has that lower rate of return. So again, we can hypothesize, but we can actually look at the data and say, well, these members, probably the long-standing early members, they had to absorb the cost of starting the club, and the inexperience of their fellow club members came into play, and so their decisions were perhaps not as sound. And so some of those early decisions didn't work out, so the unit value didn't grow. But after they found their legs, the portfolio tended to perform better. And again, we can also say maybe they started during a bull market that was followed by a bear market that devalued all of their investment choices quite a bit. And it took some time for those stocks to find reach new highs once again a couple of years later. So the member status report can give you a little bit of guidance and assistance in figuring out the question of how well the individual members have been performing. If we, again, I showed you this, we can flip back to my iClub and look at that rate of return here. And then include that compound annual rate of return. And again, you can adjust the starting of the return calculation the default is the earliest calculation, the earliest valuation in the club, the first time that a stock was purchased that's currently in the portfolio, or the first time, in this case, it would be the first time that the members put money into the club. We could start that calculation there. So, and again, turn it on, turn it off. The default is off so that we presume that you'll turn it on when you need, when you want to see that information. So we've looked at where you can find the numbers in the reports. We've talked about how they're defined, what they mean, but now we need to talk about the interpretation of those numbers. How do we know? Is 7% good or bad? Is 6%? Is 12% good or bad? And the only way that we can do that is by having something to compare it to. After all, the range of returns of the S&P 500 over the course of the history of the market, in some years the market is down 60%. In some years the market is up 40%. So over time, the average return of the S&P 500 is somewhere between 10 and 12%. So that's considered the long-term performance of the market is somewhere in there. But there's a wide range of returns. We've had recent years where the market has gone up 20%. We've had years where the market has gone just about flat. And so we need to compare how our investments are doing relative to the market. It may be that in some years we lose money in the stock market. However, that would be considered a good performance if we had done better than the overall market, and by extension, the majority of professional mutual fund managers and professional money managers in general. So we need to have something to compare it to. So in financial terms, this is called benchmarking. We find a benchmark, we compare our results to that benchmark, and then we can determine if we're performing according to our expectations or our desires. So usually the benchmark is a representative index. It could be a portfolio or a individual security. Generally, we talk about benchmarking to the index, such as the Standard & Poor's 500 index. It could be the Dow Jones Industrial Average. The Wilshire 5000 Total Market Index is commonly used. That's the 5,000 biggest stocks that are actively traded in the United States. That is the bulk of the market capitalization of publicly traded stocks in this country. And so that is incorporated in the Wilshire 5000. So that is used as one measure of the total stock market, as opposed to the S&P 500, which is largely large cap stocks, as is the Dow. The Dow is all large and mega cap stocks. So the S&P 500 has a small bit of exposure to mid-sized and small cap companies, but because it's market weighted, that again skews it towards large caps. So it's most useful to think of the S&P 500 as the large cap index. That doesn't make any difference when you're watching financial television. They talk about these different sectors. They also talk about the NASDAQ 100, which is primarily weighted with technology companies. But there's nothing stopping you from deciding that you want to benchmark your portfolio to Berkshire Hathaway. Let's benchmark our performance and compare it to Warren Buffett's and see how close we might come to his performance over time. We could also say, if we were going to simply put our money in a single equity, how would our portfolio perform. Again, I find that less useful, but you might as well. You could also use a bond index, right? A government bond or a corporate bond index, and say, well, if I put my money into a, quote, safe harbor of long-term government bonds, how much better could my portfolio perform investing in stocks? And again, the problem there is that we're not capturing any sense of the risk of investing in equities, which is supposed to outweigh and provide a premium over investing simply in the bond market. So we need to, there are lots of considerations here. Generally what happens is that we index our portfolios or benchmark our portfolios to the S&P 500 or the Wilshire 5000. That's common practice across the financial industry. Now, that might be great for the large company stocks, but you might also want to benchmark portions of your portfolio to the small cap market or the foreign stock market if you had multi-global companies. So all sorts of ways that we can slice and dice it. Now the problem is that we simply don't go and look up the returns of the S&P 500 for a calendar year and say, all right, this is what the S&P 500 earned, this is our rate of return for that year, and then say, yep, we did better than the S&P 500. The problem with that approach is, again, it's the issue of cash flows. That you and your club portfolio, you start thinking about it, you've got money coming in every month. That's the members' capital. You've got purchases of stocks that you're making. You're selling stocks at times. The stocks are rising in value. They're declining in value. You've got dividends coming in. You've got interest coming in. You're sitting on cash. A certain portion of your portfolio, you've got members withdrawing. So now there's cash going out of the club. So the issue is that we have to be able to compare apples to apples. So we can't just take the starting balance and the ending balance and say, here's the result. So what we're going to do with benchmarking is we're going to consider each cash flow in and out of the club as a purchase or a sell of shares of the index that you're comparing it to, right? So if you think about it, your club might have a couple hundred transactions in the course of the year. That is money coming in, money going out. Member capital coming in, members withdrawing their capital, that's money going out. So we're going to take those cash flows and we're going to say, all right, so instead of putting this into your club account, let's do a parallel account over here. And we're going to buy shares of an S&P 500 index fund every time that money comes into your investment club, whether or not it goes into the portfolio, the bank, the broker, we don't care. It's going to go into that portfolio that we set up, that separate account with the S&P 500 index fund in it. All right, so we're going to do that, and then we're going to calculate the compound annual return of that separate parallel account and the compound annual return of your actual club account, and now we can compare apples to apples. So we're going to do that. We're going to look at it, and we've got it for the purposes a little simplistically. We've set it up in my iClub in order to allow you to look at your year-to-date, your lifetime, in the past 1, 3, 5, and 10 years, right? So we're kind of arbitrarily cutting some period there. Now we have a little feature with my iClub that will let you set, instead of using calendar years, you can use 12-month periods that end whenever you want them to. So we have the capability of allowing you to do a little more customization there and perhaps get a little more detail than you might otherwise see it. So here on the myiClub.com website, you can see a graph. I'm going to flip back over to our myiClub, our live site. I'm going to find our portfolio performance and benchmarking report here. And so it looks something like this. So we have a couple of new features here. One, up here we can choose the ending date for our 1 year, 3 year, 5 years. By default, it's December 31st. So we can change this to, September 30th. You can change it to March 31st if you're, or April 1st if you're, want to track it as of the most recent quarter prior to this month's club meeting. You could set it to be that way. And again, the idea is we're kind of giving you the ability to kind of to perhaps get some better granularity there and a little more analysis. Now this report, we've got the data up above, but we also have the graph down below, and it's color-coded. So your club is in blue, the Vanguard 500 index fund is in green, and in this case we have the iShares 20-year plus treasury bond ETF, so long-term treasury bonds. So interestingly, year to date, that if you had invested in your club account, right here, the first column, and that's illustrated over here, your club's annual rate of return in this case was 23.25%. If you just kept the money in a bond, in the bond market, invested in the bond market, you would have had a 19.39% return. Right? So it's been a phenomenal year so far for those long-term treasury bonds. The problem is on the lifetime basis here, the second row, you can see this club has earned 4.12%. The S&P 500 has earned 7.42%, and the long-term treasury bonds 0.77%. So that's why we don't invest in the bond market over time. But you can see the 1 year, the 3 year, the 5 year. You can see those years in which the club has performed better over time. So this club has been trailing the S&P 500 as well. And again, I kind of skipped over, we use these ETFs, so the Vanguard 500 index fund has a very, 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 very low expense ratio. So it really represents the underlying index, the S&P 500 index. So we just use that ETF ticker symbol as the value to achieve to access the value of the S&P 500. As you scroll down, though, we provide the ability to choose from several different index funds. So you can choose different indexes on this report and compare your performance to, so up at the top, the core U.S. aggregate bond ETF. Here is the Morgan Stanley Capital EFA, the Emerging Index Fund. Oh, I'm sorry, this is the Emerging Markets, and below it is the EFA. That's the Europe, Australasia, Far East Index. That's large cap international stocks. So the first one is emerging market stocks. We have high yield corporate bonds. We have S&P small cap. We have the S&P 500. This is the Barra Growth Index Fund. So this is a kind of a one-off of the S&P 500, focusing on growth stocks. We have the Russell 2000, which is mostly small company stocks. We have the Dow Jones Industrials. We have the 20-year Treasury bonds. Then we have the Vanguard Total Stock Market Index, which is, I think that's the default that we use. And you can see that the yellow and the green bars here tend to be pretty close together. The total stock market and the S&P 500 tend to generate similar levels of return, very close. And in this case, the club has been trailing the market over the last few years. In the last 3 years, they've outperformed. In the last 1 year, the last calendar year, they performed really terribly, but they've come back strong in the year to date. So this report, of course, can be printed, can be created as a PDF, and you can email your club members this link and share it with them. Now, this report is only available in My iClub. It's not available in Club Accounting 3, and that's because all of this data for the index funds is just not available in the Windows program. This is something that's really unique, and because we need, daily price quotes for all of these different securities in order to generate that report. It's just not something that's built into the Club Accounting 3 program. So once you know this information, what are we going to do with it? Well, the longer term results are more meaningful, right? So as Russell alluded to earlier, there's two ways of looking at it. How's your club been performing over time, and how's it been performing lately? And you can define lately as you wish. I mean, ideally, your club would be performing, when you look at this graph, your club would be exceeding the indexes in all of those periods, but that's not likely to happen. And as we keep pointing out, for newer clubs, expenses and other startup issues can drag down your results. And it might be that you could be perfectly fine with underperforming the market. Maybe you are making a little more conservative portfolio decisions. You're buying companies that are a little less aggressive, and so that could justify your club underperforming the market on a long-term basis. And there's also something that's called the education premium that says that, well, if your club's focus is education on the one hand and enrichment on the other hand, sometimes those two kind of conflict, and we make decisions because we're focused on education, not simply because we're focused on trying to beat the market in the short term. We're keeping the focus on the long term, and that you find value in your club even if you're not beating the market, because you're getting other benefits. You're gaining knowledge, you're gaining experience, and you're gaining, so you can accept a lower rate of return because of the premium that you're paying as a result of the education that you're getting. So I think that's something that every club has to decide. You know, how important is that, and what do we accept in this report? In the returns of the club, what are we really looking for? And I think that comes down to asking yourself, how often should you be reviewing the performance in your club? As I keep saying, new clubs ignore this issue for the first 1 to 3 years even, before you even start picking up on it, and then focus on see how you maybe take a look and see how you're doing. For long-term focused investors, this is not something we need to review every month, and so again, the default is that we don't display compounded annual return when you generate your monthly valuation statement and member status report. So it could be that that's fine, and you can keep it off. If you have a very experienced club, maybe you want to take a look at those values on a more regular basis. I think that you could start off by doing an annual review. After you've closed the books for the year, maybe you want to take a look have an annual performance review where you're looking at your long-term results, you're thinking about how they have been working, and you're kind of making decisions or giving some thought to how your club is making investment decisions, and maybe deciding to make some adjustments to see if your returns can possibly be improved. And the longer-term results are more useful. You look at your 10-year, 5-year results, they're going to have much more meaning than the 1-year or 3-year results. I think our better investing approach tends to work better relative to the overall market during bear markets than during bull markets. During bull markets, a certain sort of mania takes over in the broader individual investor and institutional investor mindset, where people are willing to buy just about anything and drive up prices irrationally. But with our focus on fundamentals and our discipline, we don't get swept up as often in those high PE, aggressive growth companies, overvalued situations. So during bear markets, we recognize values there. We're not pulling all of our money out of the market. We're remaining invested. We're buying great companies at cheaper prices. And so I think we have a little bit of a bias on the value side because of the better investing discipline. And so when we have long periods of bull markets and expanding economies like we're in right now, I wouldn't be surprised if many of our clubs are looking at their recent results going, gosh, how come we're not doing better than the market? And the answer is really, I think, comes down to because there are a lot of people in the market who have no idea how to invest, but they know they don't want to put their money in bonds because of the terrible rates of return. So they've got somebody putting them into equities, and they'll probably start fleeing for the sidelines when things start to turn sour. Whereas our discipline has us fully invested through all peaks and valleys of the overall market. So what are your objectives? That's a useful discussion to have within your club. Are you willing to accept some lower risk and thereby accept lower rates of return? Are you focused on education? If you really start digging down to the causes of underperformance, some of the things that you want to be watchful for are you're spending too much on expenses. Maybe your broker commissions are too high. You've got other expenses that you could avoid and perhaps should not be paying out of the club's coffers. So certainly expenses drag down returns. Maybe you've got a bias, as many clubs do, towards large and mega cap stocks. If you like large company stocks and you are underrepresented in the small and mid cap market, well, your returns are going to be affected more likely than not because large and mega cap stocks have lower rates of return over time, whereas smaller and mid-sized companies are where you can find more growth and the resulting capital appreciation that comes from investing in those companies. So a lot of times clubs get caught up in brand name consumer goods stocks, and again, they're just not going to deliver the same amount of growth that you can get from a smaller emerging company or less popular company that's performing fundamentally well. That's going to see a bigger price increase over time. The better investing approach has us allocate our resources to both small and large companies, as well as the ones in between. And that is in part to balance out the risk-return level of large stocks and small stocks that when you add them all together can deliver a better rate of return than the overall market over time. Something to look for is if you've got too many stocks in your portfolio. The pragmatic limit, and this is the conclusion of some financial research into equity investing, is that if you have more than 20 companies in your portfio, you tend to lose a bit of return without gaining any additional bit of risk reduction. So up to about 20 companies, we're diversifying, which is good for risk, but we're still preserving the ability for our portfolios to see appreciation. After about 20 securities, our portfolios tend to become much more like mutual funds or index funds. If you've got more than 20 stocks in a portfolio, you could be much better off just simply indexing that portfolio, buying index funds, because of the propensity of those portfolios with larger number of companies to simply emulate and regress to the mean returns of the overall market. So a concentrated portfolio is much more effective than a over-diversified, excessively large in terms of number of stocks portfolio. You might also think about your club's approach to holding versus selling winners and losers. And this is a constant, ongoing educational effort that's required of individual investors as well as investment clubs, where we need to set up criteria to help us make better sell decisions. Individual investors tend to hold on to both winners and losers too long. We tend to do a good job of picking stocks at appropriate prices. However, we tend then to let our winners ride for too long until they lose their luster and start to decline. And we also tend to hold on to our underperformers on the hopes, often in vain, that those securities are going to go up in price. So that can have adverse effects on our overall rates of return. So you might want to consider as a club, what can you do to be a little more aggressive at taking action about underperforming stocks and do a little bit more of selling stocks when they reach clearly overvalued territory and reducing your exposure to them. And those can help you over the long term. I think out of all of those, the under-distribution of smaller and mid-sized companies does the most to inhibit investment club returns over time. I see lots of investment club portfolios where the members are 80% invested in the large cap stocks. They've got 10% in cash, and then the rest is in one or two smaller mid-sized companies. And those are just not going to give you the same rates of overall return as a portfolio that has identified some high quality, faster growing companies that are smaller and mid-sized altogether. So before we wrap up here, we're willing to take your questions if you have any. We've got a couple of minutes to go. We're right about at our stop time. On the iClub.com website, in the support section, we have an FAQ section there, and one of the articles is, what is compound annual return and how is it calculated? So this is for that Excel geek numbers person who really wants to dig into the industry standard calculations that go into determining compound annual return. So we give you all the nitty-gritty there, and you can take a look at it. I'll just, before we close, we do have occasions when stocks show some gain in price but have a negative compound return. And again, it's a function of this annualized nature. So short-term price swings, especially if they're quite large, can have a negative impact on your overall rate of return. Russell, before we wrap up, do you have anything to add before we to our discussion here of compound annual returns?
Yeah, a couple things. When you have stocks that go through mergers or spin-offs, the program automatically starts their compound annual return calculations for the valuation statement on the merger or spin-off date and not on the original purchase date. So sometimes you can get a stock that has a cost basis higher than the value that you have, and it says it's a positive return. It's just that company is, especially if it's in a merger or spin-off, it's because since the merger or spin-off, the value has increased, but maybe the cost basis that came over from the parent company was higher than the current value. So be careful about that with mergers and spin-offs. Interpreting those, you have to remember it starts from this merger spin-off date. Talking about too many stocks, you've done some webinars on this, but I wanted to reiterate, your overall risk goes down with the more stocks you hold, but at about 15 to 20, you pretty much get the most of the risk aversion from diversifying from in that range of 15 to 20 stocks. So you really don't need to keep adding on to cut down your risk from a concentrated portfolio.
When we look at mutual funds that have the best rates of return, especially in the small and mid-sized segments of the market, you'll see remarkably small numbers of companies, 20 to 40 or 50 funds or stocks in those entire mutual funds. They can do that because they're small funds, but because they're so concentrated, they can deliver really incredible results as long as their their shareholder base doesn't broaden so much that they have to keep buying more and more stocks, and in that smaller mid-sized market, often it gets difficult to do that. So I think that's really something that everybody can look at. Do you have companies in your portfolio that are just not working out for you? If that's the case, maybe you can get rid of a couple of them. Eric asks if My iClub has a graph or pie chart pie chart of portfolio diversification by size. If we jump over to my iClub here in the portfolio section, we've got company size diversification is the first report there, and you can see we've got a report, but as you scroll down, here is the breakdown in a pie chart of small, mid, we have large, and we have a mega category for stocks that have very large market caps. So in this case, you can see this club's portfolio is they're doing pretty good. They've got 33.6% in small company stocks, 36.6% in mid-sized company stocks, and then another 24% in large company stocks. So that's pretty good. Better Investing's recommended stock portfolio diversification looks more like this, where you aim for 50% mid-sized companies, 25% large, and 25% small by revenue. And that gives you a target to aim for the sweet spot of maximum capital appreciation potential, but reducing the risk of investing in equities. So the report is useful, but the graph, and I know that Russell's a big fan of these company diversification graphs. We have another one by industry and sector as well, and another one by projected earnings per share growth rates, which again, you want to know why your club isn't performing up to your expectations. Well, in a growth approach, in a growth portfolio, capital appreciation is going to be the key driver of returns, and capital appreciation is driven by the growth of earnings. So in this case, you can see they've got some companies with some negative growth expectations according to analysts, and a number of companies here that have growth in the 3, 5, 6% range. Again, based on the size of those companies, that could be pretty significant. And then we have a couple here greater than 12% to give you a little more oomph in the portfolio capital appreciation potential. So that, again, another way to look at why your club portfolio is not doing well when you look at the projected earnings per share growth rate. Now, we use proxy judgment and analyst expectations here. You might take a look at your own stock selection guides and figure out what the projected return is and how that compares to your objectives in order to figure out if you are performing according to those expectations. Well, I think we'll wrap it up now. I want to thank you for joining us tonight at our Investment Club webinar. We'll look forward to seeing you at our next club webinar, which will be June 20th. We're actually off for May because of the Better Investing National Convention. I hope if you're attending, I look forward to seeing you there. Otherwise, we'll look forward to seeing you in June at our next Investment Club Operations webinar. Thanks a lot, Russell, for joining us, and thanks to all of you for being with us tonight.
Good night.